All right. Welcome, everybody. Happy Black Friday shopping day. Glad you could take a break. I've been up early. I've been doing my Black Friday shopping. Hope everyone's doing well. And we are simultaneously broadcasting Charts and Coffee here for the first 20 minutes. So if you're used to jumping into the Simply Trading YouTube channel for Charts and Coffee, no worries. We're just going to broadcast it simultaneously here in the Futures and Options room. So great to see everybody. If you haven't checked out the schedule, we have myself, Taylor, David, and Henry batting cleanup here on this Friday. So thanks as always for joining us. We know who the diehards are. I love it. All right, so let's kick this off. I think we do the first 20 minutes as we have the Charts and Coffee crew, our Caffeinate and Dominate crew out there. We'll just do some rapid fire symbols for the first 20, and then the last 40 minutes, we'll go ahead and take a look at some setups, not necessarily for today, although maybe because we have the markets in kind of a jittery mood with the variant news, which I will likely fade as I have most of the other variant scenarios. But clearly it's something that with a Friday trading session that's having to absorb, that's having to discount this news, it's a little tricky because if for whatever reason this narrative dramatizes over the weekend, we start seeing the variant in more countries, there's just more fear surrounding it, we could see a difficult Monday. So even though this is a smaller shortened session, the rules still apply. Don't fade Fridays. Please don't fade Fridays. What does that mean? Well, if we see weakness and we're thinking, oh, fantastic, this is a dip, we might want to pull back into it. You can see where we are on the indices as I'm sort of scrolling through these right now. Don't feel the need to jump into some of these dips, because if we have weakness going into the close, come Monday, we'll likely see that little bit of follow through. That might mean Monday or turnaround Tuesday, if the pattern fits, we could see a resumption of the trend. Now, just a quick reminder, if you're a fan of the seasonal tendencies, not trades, but tendencies, we also know that from Halloween to New Year's Day, there's really three phases of what we would consider, generally speaking, the year-end rally. The first starts from Halloween and goes just to before Thanksgiving. The second goes from just after Thanksgiving to just before Christmas. And the last one, the Santa rally, kicks us from Christmas to New Year's Day, and maybe even slightly beyond that. So you can see this rhythm along the right edge of this seasonal. And yeah, we could say that we're sort of in that second phase of the year-end rally. So not that that's a setup, but if there is a tendency, it is to the north. And if we are going to see a recovery, again, please, as a general rule, don't fade Fridays. Okay, so let's go ahead and kick it off with some requests. And first, starting off, Donald, your question about, does a large down day invalidate the trades we have going? Terrific question. So let's quantify what a large down day is. And for that, we'll use historical volatility, which is to say, I need to look at what the typical down day for a market is. In other words, what's a lot of price movement for, we'll start with the Dow, since that's clearly the one that's getting whack-a-mole today. And what's a large day? Really anything north of 450 points. And then if we look at top to bottom right now, we're down 810. We're 2x the daily price movement range. This 1,000% means that we need to wait for a minor low or an inside day on Monday. So the Dow is not one of those indices that I would say is even aggressively, even aggro fadeable. So then the question becomes, well, what about the S&P? S&P right now, remember, the bell hasn't even rung yet. We haven't even seen the primary wave of trading. So we're down 78 points on the ES. So once again, I'll ask myself, well, actually, I'm not going to ask auto chartists, what is the typical historical volatility for something like the S&P? Notice we're well beyond that too. We're almost another 20, 23 points north of that. So once again, I would say it makes sense to just tap the brakes, know that we still have bullish directional bias, but that this narrative does still need to get discounted, to get processed. It's not baked into the cake yet. Now, the one index that is different than the other two, and I'm not talking about the Russell, I'm talking about the NASDAQ. What we know about any news surrounding COVID is always, well, tech does seem to be a relative outperformer in terms of its resiliency, its bullishness. So if I have today 153 points in the NAS in terms of range, is that the same kind of extreme we're seeing in the Dow or even slightly extreme in the S&P? And so not even close, not even close. So if there is a corner of the market we're thinking, yeah, we might aggro, maybe want to get into some micro NQ, QQQ calls, or what I actually think would be a better proxy for the NAS in terms of a broader index is the XLK. XLK is, if someone said, Rog, you want to get into tech, how do you want to go about this? Broadly into the QQQ, which is exposure to XLK, XLC, XLY, or do I want to go XLK? Well, XLK for sure. So you could think about this weakness as an opportunity to dip by XLK as opposed to going broadly with the QQQ or even the NQ futures. So those are things that are definitely on the radar. So I would say hit the pause button. I see all the questions about SPY. Yeah, hit the pause button on SPY, hit the pause button on DIA. That's going to be a Monday or a Tuesday setup after we get a minor low or inside candle. That's that pause candle we're looking for. All right, so next up from the options room. So thanks for that question from Charts and Coffee there, Donald, and about the large candles. Love it. Now, the next question is ZB from the options room here. Here's what I'll say about the 30-year long bond. Now, this would apply to ZB. This would equally apply to TLT. And that is, I'm not a huge fan of the long bond of the ZB as opposed to the 10-year or the IEF ETF alternative. The last time that we have hit the 200 propulsion dot here, the last time we've hit this, it wasn't really a firm, solid resistance level. You can see here that we pierced the heck out of it before dipping lower. And yes, there's a really good, I think there's a really good rationale for saying we could see resistance either at the higher of the two Darvis or, here we go down in here, the lower of the two. So one Darvis, two Darvi. So we've got a pair of Darvis up here. If we can get up to that level, I would think about a fade short or long TLT puts. But what I actually prefer, as long as we're talking about interest rate products, is I'd rather fade the ZN. I'd rather play the short on the ZN. And on, was it Tuesday? On Tuesday, we talked a lot about the TNX and resistance it has. Now, this is looking at the actual yield as opposed to looking at the futures contract. All right, so there's your zone where TNX starts looking quite toppy, right? And then if TNX is looking toppy, then ZN, I know we say toppy. I don't know why we don't say bottomy, but this is where it starts looking kind of bottomy. So in this regard, here's that oversold bounce, but I wouldn't really call it an oversold bounce as much as we could consider this a rip higher that looks very tempting to start looking at a short sell between the top line of the wave and the 55. So the question about ZN for me sort of segues to ZB. And then if you've never taken a look at the IEF, I would definitely take a look at the IEF. This thing's going to open up around 115 this morning. And that is very, very tempting to want to take advantage of maybe a smaller agro position in terms of long puts. Now, when I talk about agro, I'm not just nicknaming the entry zones that are triggers. I'm not trying, it's not a cutesy nickname. Actually, what agro denotes, and I know those of you in the mastery know this, but what it's actually telling us really succinctly is, look, you know what your budget is. You know what your spend is for a position. I'm a big fan of fixed bets or fixed ratio. I'm not a fan of varying bet size. And the funny thing is, I actually learned that from a honest to goodness professional gambler. I flew up to sit down and date. He wanted to learn how to day trade. So I sat down in his home office and taught him how to day trade back in probably 2002. And one of the main reasons I took the trip is he lives really close to Niagara Falls. My mom had always wanted to go. So I said, what the heck? We'll take a trip. I took my mom. We went to Niagara. And then I sat down and taught him how to trade for a few days. And what was really interesting is he was a big proponent of that. And, he changed that depending upon, well, anyways, for the most part, he started off his day. Number one, fasted. It was really interesting. He always gambled in a fasted state. And he was a big proponent of fixed bet size. And I think a lot of those approaches from poker and gambling and things like that do have some validity in our trading world. So I would take a look at the IEF and maybe spend about a third, no more than a third, preferably more so than a quarter of your budget on maybe some IEF puts as we're opening up clearly gapped higher. Just presume you're going to take heat on that position. That's why we leave another 2/3 to 3/4 of our budget out there in case we see the more moderate or conservative leg of our entry zone. So that's where that ZB conversation goes, Steve. And thanks for the question. All right. So, I tweeted this morning. I retweeted it. I wish I was that clever. I'm not. Someone retweeted and someone tweeted, said, there's a Black Friday sale in stocks today. And I kind of believe that to be true. But you know what? Instead of a Black Friday sale in stocks, especially when it comes to the S&P, especially when it comes to the Dow, let's kind of push that out to a Cyber Monday sale, right? And we'll see what kind of candles we get there in terms of an opportunity. And remember, if you're looking at specific sectors, if you're looking at the XLK, we already talked about the XLK as a proxy to the Qs. Remember that XLK, XLY, XLC, which actually XLC is really interesting to me. It's not a trend. It's not quite a downtrend, but it's threatening. This is the weakness we're seeing in communications, led mostly by the IYZ telecommunications corner of the XLC weighting. But this could be a really interesting 200 fade. And if there is an indicator, I'm not saying it's the best indicator, but in terms of psychological impact on the broader markets, nothing eclipses the sort of broad appeal of where price is in relation to a 200 simple or a 200 exponential. I prefer exponential. The main difference is the more recent the price action, the heavier it's weighted in an exponential as opposed to a straight average in a simple. So I've over the years gravitated more and more to the exponential. But that proximity gives us a very tight point of validity, either hold or I'm gone. And it gives us an opportunity to build a position right there at the most conservative edge of what is still arguably an oversold lower edge support level within the XLC, which is really kind of a tempting place to look for the 75 strike calls for 21 Jan expiration. So, if we start breaking down all the different sectors, we know XLF is going to wake up in kind of a bad mood. we know XLV is likely going to be all right, because if this news that's sending the broader markets lower is hurting XLF or DIA, IYT, XLI, healthcare XLV is probably going to be pretty darn resilient. And we do have a long position in XLV based on kind of an oversold zone. And if there is a move higher, if there is a narrative out there that's sans timing, right? We don't know when that news is going to come. But if anything, as we go into the end of the year, beginning of next, comes out in terms of new variants, as we're getting right now, XLV is going to be more resilient, and we can see that right here. So I like that dip buy on the XLV. It should hold really well. And that was when we just built the beginning of this week. So think about maybe the specificity of some of the sectors. Now, KRE. So this is a little just a little tricky. I've been wanting to get long KRE, and we were thinking, we're only going to be able to get really aggressive opportunities. KRE, if you have a Black Friday sale you are looking for, we're going to set this one up for sure in this session that we have today. KRE is your Black Friday sale. Right? If someone said, Rog, okay, I get it. Wait for Monday, Cyber Monday sales. We get it. Wait for the inside day. Wait for the minor low. KRE is your Black Friday deal. And I will most definitely be setting up probably a moderate. So I'm only spending about maybe a third, maybe a half of my budget. We'll forego the aggro on KRE, but I am going to pick some of this up, I'm thinking today, right? So depending on what kind of momentum we get when we open up, but this is my Black Friday sale game. All right, so much more specific on the individual sectors. Now, I know some folks have probably, they've been looking for this move lower, and that's cool. That's fine. In the context of an uptrend, and this is not to say that there aren't opportunities to the downside. Clearly they are. Mostly, I would say in the Dow or the S&P, I wouldn't fade the Nas, not unless you hate your money. But generally speaking, a lot of traders are thinking, what are the more vulnerable, shaky corners of the indices? And clearly, when you take a look at the yellow over yellow in the Dow, it is the one that's probably the most neutral or the least bullish of the three major indices. So, if you've been waiting for this movement lower, congrats, you've got it. I think that this idea, and it doesn't have to be this combative Yankees Red Sox thing, although a lot of people treat it that way, it's not. There's a good window of opportunity for traders who like to find inflection points in the market. That's not me, but that's okay. There's a great opportunity for some traders who like to focus on inflection points in the market and short into strength. That's cool. I am rooting for those people. So one of the things that I like to say in terms of waiting for that pullback is sometimes the most bullish thing you can be is a near-term bear. In other words, those of you that are short, I'm rooting you on. I'm thankful because that's the path to then my dip buy and the path to your first target, likely, right? So there's this thing where if someone is not short and someone's long, they're on the opposite side of the trade. Oh gosh, no, a lot of times that weakness is the pitch flying over the plate in my zone, and it's the follow through for another trader. So, that combative thing of, one person short or one person's long. Oh my gosh, remember, that's why the markets go round, and it's not always as adversarial as people like to make it to be. So those folks that are playing the short side, awesome. And thank you, because ultimately at some point, I think this market's going to continue higher. Not because I'm guessing, but because it's the path of least resistance still when you look at the structure of the market, 8, 13, 21, 34 exponentials. So this is where, hey, I'm happy for the bears and I'm happy for me too. It's actually an opportunity in different ways for both groups of traders, which is super cool. So yeah, TT, I definitely like XLV. And there's nothing really that I want to do with XLV. It's already an open trade. But again, the Black Friday deal for me is KRE for sure. All right. So let's see here. As we wrap up, I'm gonna let the charts and coffee folks go. Thanks as always for tuning in. Remember, we have a shortened trading session today. I'll see you all in charts and coffee on Monday. Signing off now, and and have a wonderful weekend. All right, be good to each other. All right, so.